Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is Building Your Model Portfolio with Equity and Debt Asset Classes. My name is Shen Chu. I'm the moderator for this session. So in this webinar, we are going to study what exactly are equity and debt asset classes and how do we use them to construct a portfolio that suit our investment objective. Now, before we begin, as usual, disclaimer, whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mention here. If you decide to make any investment decision, you're solely responsible for all your investment risk. Now, allow me to briefly introduce our speaker for today. He is the co-founder of BBB Wealth. He is also a certified financial planner and a reminder at a Malaysian securities firm. He also served as a financial columnist for the Nanyang Business Daily and financial news contributor on 8TV. With 10 years of experience in finance and investment, he specialized in macroeconomic analysis, investment product selection, and portfolio construction and management. He manages assets totaling up to 13 million Malaysian ringgit, having handled over 400 investment and financial planning cases, providing personalized investment solutions to clients. So he's none other than Mr. Hubert Hyong. So Hubert, how are you today?
Hi, Shane. Good evening, everyone.
Yes, a pleasure to have you speak to with us today. So without further ado, I will just hand over the session to you, Hubert.
Okay, sure. Thanks, Jane. So let me share the screen first. Okay. All right. So everyone can see my screen, right?
Yes.
Okay, can. So today's topic, we are going to explore the fundamentals of building a diversified investment portfolio, which is tailored to your specific financial goals and risk tolerance. So whether you are just starting your investment journey or looking to refine your existing strategy, so this session will provide a valuable insight and practical tips. So we'll begin by understanding this today outline. Okay, so we will begin by understanding what the model portfolio is and why it is important. And then we will dive into different asset classes, namely equities and bonds, and discuss how they fit into our investment strategy. And then we also will look at how to determine our risk tolerance and set the financial goals, which are the key steps in creating a high personalized finance portfolio. So next, we will explore three samples portfolios, which is conservative, balanced, and aggressive, to see how different allocation can match to our various risk appetites. And finally, last but not least, we will talk about the importance of rebalancing your portfolio and how to do it effectively. So our objective today is to equip you with the knowledge and the tools that you need to make the informed investment decisions, which can help you to achieve your financial objective with a confidence. So let's get started by understanding the basics of the model portfolio first. So what is a model portfolio? Okay, so a model portfolio provides us a structured way to allocate the assets across different types of investment. So this framework is tailored to align with our specific risk tolerance and also the financial goals. So it can ensure that our portfolio will reflect our personal financial situation, and also it serves as a benchmark for our investment decision. So which can help us to compare our actual performance with a predefined strategy. So why we need to build a model portfolio? Why it is important? Okay, so there's three reasons here. So the first one is it can help investors, which is us, to achieve our financial goals by providing us a clear, structured path instead of just making a ad hoc investment decision. So we can just follow a systematic approach, which can help us to reduce the chances of errors. And then the second one is it brings us a structured approach to investing, ensure that all the decisions are made within a best framework. And then also it can reduce our emotional decision making. So when the market is fluctuate, okay, it is easy to react impulsively. So a model portfolio can help to keep our emotion in check by sticking to a well thought out plan. So the second part, so let us to understand what is the asset classes. So actually, there are two asset classes we need to know. So the first one is equities. So what is equities? Equities refer to the stocks, okay, which represent the ownership in the companies, like what we trade in Bursa Malaysia or like US, okay, the stocks we bought, like Nvidia or even Bursa Malaysia or Maybank, all these are classified into equities, okay. But then equity is potential for high return, but and also like high risk, high return. So the higher risk is due to the market fluctuation. And then the second one is debt. So debts refer to bonds, which are the loans made to the companies or also government. So bonds generally will carry a lower risk as compared to the equities. And also it provide a steady income through the interest payments. So understanding the characteristic of these two asset classes is very important for us to have an effective portfolio construction. So in a simple words, equity is lower risk than debt. Okay, debt also is considered as bonds. Okay, so those are the example for equities and debt. So for equity, we can see that there are three types of equity here, which you can buy from different stock market. Okay, so the first one like stock, like what I mentioned just now, like what Maybank, Gamuda, and Ecover, and then the ETF is also considered as equity. Like if we want to trade the market index, we can just straight away buy the S&P 500 ETF, or we are positive to the tech sector, okay, like US sector, then we can straight away to buy the semiconductor ETF. And then as also other than stocks ETF, we can also buy the equity funds. If you want a peace of mind, we don't want to trade ourselves because maybe some of us have the limited time to access to the market. Sometimes when we after work, okay, we do not have the enough time to trade the market, to look at the market, or even to monitor our portfolio. So better way is to pass our money to a fund manager or a advisor to let them to manage our portfolio. So what we can do is we can buy equity funds. Okay, like the most performing Malaysia fund in the past few years is the CAF Core Income Fund. Okay, so this is an example for the equity fund. And then for the second one is the debt. Okay, so there are few types of bonds in Malaysia, okay. But the usual bonds that we see is the corporate bond, okay, which some of you here, if you have the banking premier banking status in bank, I believe that there are many bankers, so-called RM, will approach you to sell you the bonds. So this is a corporate bond, okay. So in Malaysia right now, the interest rate environment is about 4 to 5% the interest rate. So you can get a better rate in this interest rate environment. For example, like Malaysia government, Malaysia corporate bond is the best option to, if you want to look at a fixed payment in a fixed income asset. Okay, so which the corporate bond, and then also for the government bond, which you can lend your money to government, and then they will give you a fixed return like annually 3 to now it's about 2 to 3%, 3.5% is compared to the it depends on the OPR rate. Okay, so another one is you don't want to worry. If you don't want to if you want to peace of mind, so you can like the equity fund, you can just buy the bond fund, which is like N bond fund. So there's a advisor help you to manage your funds. So these are the two examples for the asset classes. And then we see the next one. So understanding our risk tolerance. Okay, so how to understand our risk tolerance? So understanding our risk tolerance is very important when during the constructing our portfolio. So our risk tolerance is influenced by few factors. Okay, you can see here. The first one is the investment experience. Okay, and another one is financial situation and the time horizon and the personality. So experienced investor they may be comfortable with the higher risk. Okay, but then your financial situation, such as your income stability and your net worth, will affect how much risk you can afford. And the time horizon is a period you plan to invest before you need the money. Okay, longer horizon typically will allow for the higher risk. And lastly, your personality and your emotional response to the market situation also plays a significant role in determining your risk tolerance. So these are the goals we can classify into three goals. So the first is short-term goals. Okay, short-term goals, it can be like your saving for a house down payment or for a vacation. Usually it's spent 1 to 5 years. And then another one is for the medium term goals. So such as funding your our children education or making a major purchase extend beyond like 5 to 10 years. And then for long-term goals like building your retirement funds, typically stretch over more than 10 to 20 years. So identifying these goals help in tailoring your portfolio to ensure the right balance of risk and return across the different time horizons. So this, you can see here, this is the U curve between risk and return. So basically, risk and return are directly related, as shown here by this U curve. So higher risk usually means higher potential return, but also it will bring in, it will result in a greater volatility. So investor can be classified into three risk appetites, which is conservative. Okay, very conservative. Actually, there is a middle here, conservative, more conservative, and then a moderate, and then another one is aggressive, and then very aggressive. So total, we can see there's a 5 types there. Okay, so conservative investor will prioritize capital preservation, and they are comfortable with lower returns. And for the moderate investor, okay, they will usually seek a balance between risk and return. Okay, they won't see the higher return, and then they don't want a lower return, so they're in the middle there. Okay, so for the aggressive investor, they are willing to take on higher risk for the chance of substantial return. So understanding where you fall on this category is the key, okay, to constructing a portfolio that align with your risk tolerance and goal. Okay, so here we will show you the three sample portfolios. So you can see here there are three types of portfolio that actually you can go and think how can you restructure based on these three types of portfolio. Okay, so it also reflects the different risk appetite. So you can see the first one is conservative portfolio. Okay, so a conservative portfolio has 20% equity and 80% bonds. So this portfolio will focus on the stability and income. Okay, so that means that during the market volatility, when the market volatility is very high, okay, you will put more allocation on the bond market, okay, to preserve your capital, and then you will just reduce the allocation equity. So you will make your portfolio become a more conservative type. Okay, but then when the market is not so volatile and then not so the performance is not so really well, then you can convert your portfolio into a balanced portfolio. Okay, so a balanced portfolio, you can see here, okay, it has an equal split between equities and bond. So the objective of this balanced portfolio is to aiming for a moderate growth with control risk, which means that you can look for a potential growth with a limited risk. Okay, And then for an aggressive portfolio, you can see here, it consists of 80% equities and 20% bonds. So it targets a high growth with a higher volatility. So this example will provide a starting point and can be adjusted based on individual risk, tolerance, and financial goals. So here are the three different samples of model portfolio which we can refer to and then think which portfolio that we're holding is fall under into which type of model portfolio. Okay, so I will go one by one. So the first one, conservative portfolio. So conservative portfolio will prioritize in the capital preservation and the steady income. So the equity portion at 20%, okay, includes the large cap stocks from the established company and the dividend paying stock, which are the good quality company or good quality stocks. It's not the penny stocks. Okay, so they will provide you the regular income. And then for the debt portion at 80%, it focuses on the government bonds and for the stability and high quality corporate bond for the moderate income. So this portfolio is very suitable for those investors with low risk tolerance, such as retirees or those you are closing to your retirement age. Okay, so another one is a balanced portfolio. So for the balanced portfolio, okay, is a portfolio. A balanced portfolio seeks a middle ground between risk and return, okay, with a 50-50 split between equities and bonds. Okay, the equity portions includes a large cap stock for stability, and then for the mid cap stocks, okay, is for the growth potential, and the international stocks is for diversification. And then for the debt portion is eventually is split into the government bonds for safety and for the corporate bonds are for higher yield. So this portfolio is suitable for the investor who look for moderate risk tolerance, who want a mix of income and growth. Okay, so for an aggressive portfolio, so aggressive portfolio aims for high growth. Okay, so we can see here, there will be a lot of equity portion there. So the first are large cap stocks, okay, which you can buy some large cap, like blue chip stocks like Maybank or Gamuda or Bursa. Okay, you can add them into your portfolio. And then, but then the difference between the balanced portfolio and conservative portfolio, right? So you can see our conservative portfolio here. The portfolio here doesn't have the small cap stock, okay? But then with this aggressive portfolio, those people will add the small cap stocks in the aggressive portfolio because it can give you a very high potential returns, but also high risk, high return. So if you want to seek for a higher return, then the downside is that you will be facing a very high downside risk, okay? So another one you can see here, and then there's a emerging market stocks, okay, which also can give you a high growth potential, okay, than others. You can see conservative portfolio here, you are just focusing on buying those very stable companies, okay, like blue chips, large cap companies, okay, and then you also will be focused on those stable market like US, like Malaysia, okay, or other developed country like Singapore or Japan or Europe countries, okay? So all these markets are very established, so you can just invest into this market, that the market will not be very volatile, okay? But then as compared to the aggressive portfolio, right, the investors will more prefer to investing in the emerging market stock, because like emerging market stock like in Malaysia or Indonesia or Vietnam, all these markets can have a very high potential growth. So when the economy is booming, the stock market also will be booming. So you can get a very sexy return from all these markets, okay? But then don't forget that because now you are construct a portfolio with a diversified portfolio, so you cannot just you cannot just have your equity in your portfolio. So we also want to add some of the other asset classes into your portfolio, which is bonds. Okay, so the bond component in this aggressive portfolio is not so high as compared to the conservative portfolio and balanced portfolio, because this type is an aggressive portfolio. Okay, but why we should add bonds into our portfolio? The reason being is because it can control the risk. Let's imagine if during a stock market crash, if all our 100% of the capital is all in 100% in the capital market or in the stock market, okay, when the stock market crash up, so all your 100% allocation will be affected. Okay, mean, for example, like if stock market down 10%, so your portfolio will down 10% as well. So if stock market down 20% and your portfolio will down 20% as well. Okay, but then if you have the bonds element in your portfolio, even when the stock market down 10%, maybe your portfolio is down maybe like below 10%, like 7 to 8%, because you have another investment in bonds which can help you to hedge the risk. Okay, so for this type of investor, for the bond, for the option of bond, you can stick for corporate bonds. Okay, for the corporate bonds or those high yield bonds. Okay, high yield bonds meaning that it is a higher risk and higher yield, which you can see the credit rating there. Okay, so you can see here conservative portfolio will be focusing to buy those high quality corporate bond like Maybank. Okay, Maybank to offer to issue their corporate bonds in the bond market. So and then for this one, high yield bonds are those small or medium to small companies. Okay, they will also issue some bonds, but then because of their their low credit rating, okay, so they will give you compensate you with a higher return. Okay, so maybe you will get 7 to 8%. Okay, 7 to 8% coupon interest rate per year. Okay, as compared to this conservative portfolio, the bond there is not so high, but then it can give you a stable return, so you don't need to worry about whether this company will bankrupt or not. Okay, whether I will face the default risk or not. Okay, so the next one is rebalancing our portfolio. So this is very important when we want to construct our portfolio. It's not only just about the allocation only. Okay, so if you just rely on the allocation, okay, it's not the fixed allocation. I mean, for example, like today I have done the assessment or risk profile assessment. Okay, I get to know that my profile is a conservative investor. So I will just follow this allocation to construct my portfolio, which is 80% on bonds and 20% equities. Okay, and then I just leave it there and then for 10 to 20 years. Okay, we cannot do so because market will change time from time. Okay, when the market change, okay, we need to rebalance our portfolio. Okay, so how to rebalance? Okay, what is rebalancing? Okay, so rebalancing is involve adjusting your portfolio. Okay, to maintain your ideal asset allocation. Okay, this also means that underweighing the equities when the equity market outlook is gloomy. Okay, what does it mean? Okay, it means that when we see the market now, the stock market valuation is very high, and then we were trying to do what? We were trying to sell some of my shares, okay, and then reduce the allocation in stock market. Okay, reduce the allocation in our in stock market and increase the allocation in debt, which you can imagine was we sell our shares and then we use the capital to buy into bond. Okay, and then but when we see the stock market is very good, Okay, the valuation is not very high, it's very cheap. So what we do is we will try to sell off our bonds and then use the capital to buy into stock market, okay, to enjoy the potential, the higher potential return from the stock market. So this is a rebalancing, okay. But then when to rebalance? When to rebalance? This question is very a lot of people like to ask when to rebalance. So it have two types. So the first type is regularly, okay. Either is on monthly or semi-annually, okay. And then this one is to maintain your target allocation. Alternative rebalance should be considered when your portfolio changed significantly from its target allocation due to the market movement. So this will help in your realigning your portfolio with your original investment strategies. Okay, so go back to here. What is rebalancing? Okay, when to rebalance our portfolio. So like for our approach, right, we do also help our clients to manage our portfolio. So what we do is that we see the stock market right now, US market is very volatile. Okay, so what we do is we reduce the stock allocation in US market, and then we add the allocation in Malaysian market. Okay, so this could be two angle. So it's intra and whether it's in diversification from the region wise and diversification from the asset classes wise. Okay, so if for the asset classes, we need to see the valuation of both market. Okay, whether the bond market right now is overvalued or undervalued, and then the stock market is overvalued or undervalued. Okay, so if the stock market is overvalued, what we do is to sell off some shares, okay, reduce the allocation, and then add more in the stock market, okay, to hedge our risk, okay, to make it more diversified, okay. So and then for the region part also, so within the asset classes of the equity, right, we can also go and evaluate which region or which stock market are underperforming or overperforming or undervalued or overvalued. So for example, like we can see that US market right now is very volatile. Okay, so we can see the Dow Jones index every day can up 10% and then drop another 10%. Okay, so it's very volatile right now. So what we do is if we see the uncertainty is very high, so we can try to reduce the allocation first. We don't exit at all, okay? Because in investment world, we need to stay invest with the market, because if you sell off all your investment at one time, and then maybe tomorrow the market rebounds 10%, then you miss the opportunities already. So stay invested with the market, okay? What we do is to increase or reduce the allocation when the market volatility is very high, okay, volatility is very high. So what we do, we just use the allocation strategy. We add or reduce, add or reduce, okay? So we see US market volatility is very high, then we just reduce the allocation. So we use the capital to add more in Malaysia, because you can see Malaysian market right now, the valuation is still cheap as compared to the other countries in the whole Asian market, okay? Because like last year, Malaysian market, all the other Asian country already, the stock market already fried, okay, already fried. But then you see Malaysian market is still underperformed. Okay, it's still underperformed. But then what we see this year at the beginning of the year, the Malaysian market, the KLCI index already started to rise. Okay, started to rise. So if I'm not mistaken, the KLCI year-to-date index is already close to 10 to 11% for the big cap, and then for the small cap index already above 10%. Okay, above 10%. And now we are in the retracing stage. So it's the best time for us to see which company is with the good value. Okay, because during the stock market the booming, when the stock market booming, everyone will trying to get involved in this stock market. Okay, so when everyone is get involved in this stock market, the stock market is very high. Okay, you can see the chart there. The curve the chart is the very stagnant one. Okay, but then when the market is retraced, okay, it will start to drop back. Okay, we will start to drop back. But if we see the trend is long-term trend, okay, when the market is retraced, then it's the best time for us to actually add more allocation in this market. Okay, so especially Malaysian market, the valuation is still cheap. Okay, and then there are many catalysts are coming in, like the AI team and the construction team. Okay, many mega projects are being announced. Like we can see for the past few months, the government has just announced some of the mega project like HSR. Yeah, so you can see the construction sector index are also doing pretty well. Okay, and then it is the best performing sector among all the industries. Okay, so all these information and all these analysis we can actually do and evaluate which market is good and which market is bad now. Okay, if it is bad now, we don't totally exit from the market. Okay, we just reduce the allocation. Okay, and then we just use the allocation to add into the other market. Okay. Okay. So when to rebalance, well, says so just now I mentioned already. So regularly, okay, please to check or monitor your portfolio regularly. Okay, please don't just open your portfolio once in the one year, because when we open our app, okay, because usually when the stock market is bad, people will not look at their portfolio. Okay, they will just close the some of the people, they will just uninstall the app. Okay, I don't want to see more. But when the stock market is good, then I will just install back the app and then see, hey, my portfolio started to be green. Okay, not red anymore. Okay, and then at that moment, those people losing money in the past, they will started to think how to rebalance my portfolio, because stock market right now is very good. So I need to think which stock that I can buy to help me actually to escape from the losing portfolio. Okay, but then this way is not really advisable because we need to restructure our portfolio or rebalance our portfolio from time to time. If the market is bad now, then also it's very crucial for us, okay, to start to do the rebalancing. Okay, what we do, maybe we see the stock market is not really doing very well. Okay, we don't know which stock that I can sell and then I can buy. Okay, so what we do is rebalancing within the asset classes, like I say just now. Okay, all these three types of the portfolio. So if we see the stock market like last year, Malaysian market is not doing really well. So what we do is we reduce allocation. Okay, reduce allocation maybe from 80% equities to 50%, or maybe 80% on bonds. Okay, so from here you can actually enjoy a very stable income provided by the bonds. Okay, and also if you have the target allocation, like for example, if you are a conservative or a balanced or a moderate investor, okay, you have a target allocation. Okay, so you maybe what you do is you won't go for a very extreme allocation like from 50% to 80%. So this one is too extreme already. Maybe you can apply a 10% plus minus difference. Maybe like when the stock market is good, maybe I can reduce 10% from that, okay, which is the bond market, and then add 10% to the equity, which you can add from 50% to the 60%. Okay, but then if you see stock market is not doing really well, okay, what we do is we sell off some shares on the stock market. Okay, so for stock market, okay, from 50% to 40%, okay, and then add more a bit on debt, okay, which is the bond market, from maybe from 50 to 60. So we can do it like very flexible. Okay. Okay, so my session is that's all my session. Any question?
Okay, so if you have any questions to ask our speaker today, you may write them at the Q&A box. Okay, I've seen the first question on my panel. It is asked by Eugene. Would it be a good idea to reduce equities exposure and increase fixed income exposure as you age and approach retirement?
Yes, yes. Because if you're near to your retirement age, like you will be focusing on a more conservative portfolio. Because if you put much allocation on the equity market, so when the market volatility is high, it will affect your retirement lifestyle as well.
I see. All right. Thanks, Hubert. So the next question is by Kennedy. Is there any test to determine our risk profile, whether it is conservative, moderate or aggressive?
Okay. Yes, there is some so-called risk profile assessment. Okay, there's available on webs on the online. You can search risk profile or risk appetite assessment. So there's many questionnaire out there lah. So you can just click and open and then to complete all the questionnaire, and then you will know which category of investor you are.
All right. The next question is, where can we find more information about the bonds that we have in Malaysia?
Okay. There is a platform called Fund Supermart. Maybe I can share screen, show you. Okay. Okay. Or you can go with Bond Supermart. Okay. So
Fund
this
and
is
Bond
the
Supermart.
Fund Supermart or Bond Supermart. So the Bond Supermart is the marketplace that where you can go and search those bonds. Okay. Maybe like you want to search Malaysia bond. Okay. These are there are so many currency bonds. Okay, you can see here. So the vision, for example, like if you want to search Malaysia bonds, and then from here you can select which you are seeking. Okay, maybe you want to look for a 4 to 6% yield bond. Then you can click. Okay, so the maturity, maybe you want to look for a 3 to 5 years bond. Okay, then the coupon rate, okay, maybe 2 to 6%. Okay, and then for the bond type, okay, for bond type, maybe you want to look for a conservative bond, okay, which is not a high yield bond, so you can just select the exact security or the corporate bond. Okay, you just click search. Okay, so this is all the available bonds based on
We are not
our
seeing your screen, Hubert.
criteria.
We are seeing your PowerPoint.
Wait, yeah. Okay, here. Can you all see my screen right now?
Yes, yes.
Okay, so I just repeat again. So we can go to a website called Fund Supermart. Okay, so here Bond Supermart, sorry. So Bond Supermart is a platform where we can go and search all the bonds available in the market. Okay, so here you can select your filters. So you can come here to select which one you would like to select. For example, like if you look for a Malaysia bond, so you can just select Malaysia, okay? And then for the yield to maturity, which one you want to look for, okay? Maybe you want to select the 2 to 4%, okay, 2.4%. And then for the maturity, Okay, for maturity, maybe you want a longer tenure. So maybe you want to a longer tenure. I can choose for 5 to 8 years. Okay, so coupon rate. Coupon rate is that the fixed payment, the annual fixed payment that you can get from the companies. Okay, so maybe I want to get a fixed payment of 4 to 6% per year. Okay, for at least 5 to 8 years. Okay, so for the bond type, so you can see there are 5 bond types here. Okay, if you are a conservative bond holders, okay, you are looking for more bonds which with a stability. Okay, so you can choose asset-backed security or the corporate bonds. Okay, so you just click search. So the result will come out here. So you can see there's a lot of option here. You can go and select. Okay. And then it will show which sector the company is, and then the maturity date, the ask price right now, which you can, and then and also the credit rating here also. Okay, and then for the funds one, the fund you can go to the platform called Fund Supermarket, FSN1. So FSN1 here you can search the funds there here. Okay, so you can go here, funds homepage. Okay, so here you can see all the best performing funds at this moment. Okay, the best performing fund you can see here, and then also for the worst performing fund also you can see here. Okay, you can search here. Okay, and then you want to choose the funds that you would like to search for, then you can see here. Okay, so you can select here. Okay, there's many filters here, like I can say, like asset classes. So if you want, if you think that select a bond is very difficult because not everyone can have the knowledge to select a bond. Actually, and especially when it's come to us analyzing a bond. Okay, because analyzing bonds is quite different from analyzing a company. Because when we want to analyze a company to see which stock is overvalued, undervalued, is very straightforward. We can just open the financial report and see, okay, this company, the financial statement is healthy or not, or the share price are overvalued or undervalued, okay? But then for the bonds, right, you have to know the interest rate environment. So the relationship between the interest rate and the bond prices is when the interest rate is high, the bond price will drop, okay? But then when the interest rate is very low, the bond prices will up. Okay, so this is the relationship between the interest rate and bonds. So if you do not have the knowledge about the interest rate environment, okay, you can just go and invest in bond funds. So bond fund is where there is a funds that fund manager will help you to filter, okay, which bonds are good to buy and with a good quality, and then they will add into a portfolio to construct as a bond portfolio, which is a bond fund. So maybe you can select fixed income. Okay, so fixed income, when you select fixed income, then all the bonds fund in the Malaysia, okay, will be shown here. So we can see which bonds fund that you would like to invest in. Okay, so this is the platform that we can utilize it. That is a free one. Okay, FSM1 and the bond supermarket.
Thank you, Hubert.
Okay.
The next question is, may I know if buying bond index fund is comparable to buying bonds directly?
Do you mean, okay, buying a bond index fund, do you mean bond ETF?
I think what he means is this bond fund. I think he refer it as bond fund.
Okay, bond fund, yeah, it's actually the same. So if you don't know how to analyze a bond, then better you just invest in bond fund. It's really the same.
Okay, how about ETF versus buying bond?
ETF versus buying bond.
Yeah,
If
buying
you mean
bond
if you
ETF.
mean okay, bond ETF, also actually the same, actually the same. But then you have to analyze as well because a bond ETF is on different markets. Maybe if you buy a US bond ETF, okay, or the Malaysia, but Malaysia doesn't have the bond ETF. Only Malaysia is available. But then the selection is not so many, it's quite limited. So better way is to buy into the Malaysia bond fund because the first reason is because US interest rate is very volatile. And then bond is very sensitive to the interest rate. Okay, if you buy into the US bonds, you will expose to a very high risk. Okay, especially now, Federal Reserve is going to reduce. It is going to cut the rate. Okay, so when you cut the rate, the coupon rate of the bond will also drop. Okay, so it will affect all the bond prices. Okay, but then if for the Malaysian market, our interest rate environment is quite stable. You can see our OPR is maintained at around 2.5 to 3. Okay, it's very stable. And also, if Bank of Ghana were to cut the rate, it won't cut as high as what the Federal Reserve will be doing. Okay, so Malaysia bond fund is quite stable as compared to the US bond.
All right, thanks. Shannon would like to ask, how do we buy bonds? Is it through the local banks?
Okay, there are 3 channels that you can buy bonds. The first channel is that through like what you say, through banks, especially like banks RM. So sometimes RM will approach you and then tell you that hey, there is some bond just newly launching. Will you be interested to buy the bond or not? But then for those bankers they actually don't really go and study and analyze the bond. So actually, the homework is rely on their investment consultant. So their investment consultant will access to the bond information, and after their analysis, again they will just share to their RMs, and then RMs will sell you the bonds. So and then the bank sale charge is quite high for the bonds. Usually priced at 3%, around 3%. Okay, this is the first channel you can buy from banks. And then for a second channel, there is that what I showed just now. You can buy from the marketplace like bond supermarket or fund supermarket. Okay, because their entry is quite low, as low as 5,000. You can buy a retail bond. Okay, but then the problem is that you need to DIY. Okay, you need to choose which bond you would like to invest in. Okay, you need to do your own analysis. You need to do your own research for this. And then the third one is that actually you can go and approach an advisor or so-called consultant, maybe like us, like a financial planner. So you can approach us to seek for our help to see your risk profile first. Okay, to understand your risk profile. Maybe we find out that you are a conservative investor. So we will see in the market which bonds are suitable for you. So we will filter and then recommend few bonds for you to invest in. So these are 3 types of channels.
All right. So for one of the channels that you mentioned, which is the bank, right? You say the bank may charge you 3% initial sales charge. So in other words, if the bond is giving say 5% yield, then paying up 3% initial sales charge will mean that we only have 2% gain from the first year. Am I right?
Yes, you can say so. But then for the upfront fee, you for the sales charge you pay an upfront, right? And actually you can average out for the 5 years. Depends on the maturity lah. Let's say your holding period is 5 years. Okay, every year you can get maybe like 5% yield, 5% coupon. So 5, the total up you can get a 35% coupon, the coupon rate. And then at the upfront, you're just paying 3% you charge. So minus off you the total net yield you can get is 22%.
All right. Thanks, Hubert. So Ahmad Shamil would like to ask, can we buy government MGS directly from Bursa Malaysia?
What I know is that I'm not sure whether Bursa Malaysia can buy the MGS or not lah. Okay, but then I can what I know is that Fine Supermarket can buy okay the MGS.
All right. So Fel would like to ask, after we purchase the bond, are we required to hold them until maturity?
Typically yes, because the reason you buy bonds is to you don't want you want to enjoy the stability of the bond. You don't want the volatility. It's not like stocks. When you buy it, you need to monitor from time to time. Like every month, you need to open the financial report, and then go analyze how is the company performance. But then for bonds, like in the first place, you already analyze the bonds, whether it is a good company or the bad company, and then how is the financial performance is. Okay, because when we analyze the bonds, we need to emphasize on the we need to focus on the financial health of the company. Okay, whether the company has a very high gearing ratio or very low gearing ratio. If the company is with the very high gearing, okay, then we need to be careful, because there's a probability that the company may not be able to pay off their interest rate to pay off their interest payment to their bondholders in the next few years. So this may be the alert that we need to be careful.
Thanks, Hubert. The next question is, how long of a bond maturity period is recommended to maintain sufficient liquidity?
Liquidity. You mean how long the maturity that I need to buy to maintain the liquidity? Okay, there's one way that we can there's a bond buying strategy lah. Let's say if we want to have like maybe 5,000 passive income every year. So what we do is that we can go and search for the bond that can pay with 5,000, which is 5,000 you can convert into the 5% yield, right? 5,000 is 5%. Then you can invest with 100 ringgit, 100,000 ringgit bonds. So if you can use a 100,000 to buy into the bond that can pay you a 5% coupon rate every year. Okay, so the first year you do so you will get a 5,000 ringgit, and then for the second year you can also buy another 100,000 ringgit bonds. Okay, to pay you another 5,000. Okay, so third year, fourth year, and fifth year you do accordingly. You do the same. Okay, until the fifth year, maybe every year you buy the 5 years maturity bond. Okay, until the fifth year, the first bond will be matured. Okay, so after the bond matured, okay, you will get back the capital, and then you use the capital to buy into the new bond in on the year 6. Okay, but then on the year 6, you still have the coupon rate you can receive from the second bond you bought in the year 2.
Thanks, Hubert. The next question is, how does bond price move and what affects the bond prices?
Okay, what does the bond price? Okay, like what I said just now, it's all about the interest rate. So when the interest rate, okay, is high, the bond prices will drop. Okay, when the interest rate is low, the bond price will up. So this is the relationship between the bond prices and the interest rate.
So let's say US Federal Reserve cut the interest rate in September. So bond prices are expected to go up, right? So if they cut the interest rate very steep and very fast, then the bond prices may skyrocket. So in that case, would you recommend us to sell the bond because we could have walked away with, very good capital appreciation instead of holding until maturity?
Okay, so the impact of the Federal Reserve, if they cut the interest rate on the bonds, right? So it has a significant impact on the bond market lah. So actually, when the Federal Reserve cut interest rate, the existing bonds with the higher coupon rates will become more attractive as compared to the new bonds issued at the lower rates. So this increased demand will actually push up the prices of the existing bonds. And also the yield will fall, the bond yield will fall. As the bond prices rise, okay, the bond yield will fall. Okay, the yield is the return and the investor can expect from holding the bond until maturity. So, and when the prices increases, the yield decreases because the fixed coupon payment represents a smaller percentage of the bond price. So the strategy is that maybe the investor holding bonds will see an increase in the market value of their bonds. Okay, so it can be a particular beneficiary to those holding the long-term bonds.
All right, thanks, Hubert. So let's say we want to buy corporate bond. Would it be wise for us to study the company and the financials if you want to do that? So this is the question by Eugene.
Sorry, you can repeat the question again.
If you want to buy a corporate bonds, right, issued by the company, so would it be wise that we study the company and the financials when we want to buy the bond?
Yeah, of course, you need to study the company, especially what is the company doing, okay, which sector, what business they are doing, and then especially we need to focus on studying their financial reports, okay. So what we do is to look at the financial reports, the financial statements, especially on the asset, the balance sheet, okay. We need to know how much is the debt level that the company have, and then what is the ability that the company can pay off their interest payment and the bond. What if until the maturity the company doesn't have enough cash flow to pay off the bond payment to the bondholder? Then what will happen?
So what will affect the prices of corporate bond? Is it still the interest rate, or it is more like the fundamentals of the company? Like if Federal Reserve cut the interest rate, will it affect the corporate bond issued by the Naga National Berhad, for instance, or Bank Negara cut the interest rate will affect the Naga corporate bond, for instance? And is it more related to the company fundamental, like their credit worthiness?
I can say both also will affect the bond prices lah. So the interest rate and then also the fundamental of the company will also affect the bond prices. Like we can see an example like Pestec. Pestec is a bond. Okay, is the construction company. Okay, and last year the company faced a liquidity problem in the company. You can see the bond price are falls from 100 ringgit, from 100 principal amount to 60 to 70 ringgit, okay, for the bond prices. So it's also we need to analyze the fundamentals of company. So what I say just now, we really need to look at the financial report, the financial and the financial health of the company, whether or not they are able to pay off their interest rate, the interest, yes.
All right, thanks, Hubert. Is there a minimum amount if you want to invest in debt?
Okay. If for banks, the minimum amount to invest in the bond is 200,000, or more, 250,000. Okay, for one lot. But then there are some other channels that we can buy at the lower price, like what mentioned just now, like fund supermarket. Actually, we can buy the bonds at a very low price there, like a minimum entry is 5,000 ringgit.
Yeah, on Bursa Malaysia, you can also buy exchange traded bonds and sukuk, which typically will only cost you 1,000 over ringgit if you just buy one bond lot. Yep, these are I think there are two exchange traded bonds and sukuk issued at they are listed at the moment. The next question is, can you explain what are the benefits if we buy bonds when the high debt percentage happen? If I understand your question correctly, that question is by Masniza.
Why was the question actually? Sorry, what are the benefits?
I think that's what he means, because the question is not in the complete sentence. So can you explain what are the benefits if we were to buy bond when the high debt percentage happen?
Not really understand the question.
Okay, maybe Masniza, maybe you can rephrase the question so we can understand your questions correctly. Yeah, he typed the question in the chat box. The next question is, what are the common mistakes investors make when it comes to building a portfolio?
What are the common mistakes made when building a portfolio? Okay, so the first mistake that I usually see a lot of investors doing the mistakes that there are lack of the diversification. So many investors concentrate their investment in a few asset classes or specific stocks. So this will result in a very high risk. So what can we do is to diversify across different asset classes, like I said just now, whether it could be believe it could be equities, bond, or even properties. And then also we can diversify across different sectors or even the geographical region to spread the risk.
All right, thanks, Hubert. So how should investors adjust their portfolio over time in response to life changes or market shift?
How should investors adjust their portfolio over time in response to life changes or market shift? Okay, so for example, like the stock market is overvalued. Okay, so when you see the stock market is overvalued, it's very high. So there might be a very high possibility that the stock market will go down. Okay, because the downside rate is very high. So what we do is we reduce the allocation. We adjust the allocation we adjust our portfolio by reducing the allocation in stock market. Okay, so we just adding more allocation in the debt, in the bonds. So over time, in response to the life changes and the market shift.
All right, so there's one question by Eugene, which want to clarify that was the best performing bond fund that you showed just now, CAF Core Income Fund? Is that correct?
Yes, correct.
Oh, all right. Okay, I think his eyes are very sharp. So what factors should be considered when selecting the specific equities and debt instruments?
Okay, what specific factor? Okay, so for stocks, it's very simple. So you need to know today if you invest in the stock, you based on what strategies. You are a long-term investor or a short-term investor. So if you are a long-term investor, okay, normally the long-term investor, what they do is they will use the FA, fundamental analysis, to go to study and research a company. Okay, we see the whole financial situation of the company. Okay, we will assess based on their cash flow, their earnings, their the profitability and then the potential growth. Okay, but then for the short-term investor or so-called short-term traders, what we do is we will just look at the chart, okay, to draw the support line or the resistance line, okay, to find out the demand and the supply of the market, which one could be the support prices, okay. So we tend to buy low and sell high. What we do is we will buy at support, okay, and then we set a take profit point. Maybe we can set it at the resistance, okay. So this is the point that where the prices near to the resistance, okay, there will be a high possibility that the price will go down. Okay, so we can set a TP there. Okay, so when the price hit the resistance line, so we can take profit. Okay, and then another hand, the support line. Okay, from the word we can know that is a support. So this is a support that the stock price cannot drop below. So if the stock price drop below the support, what we do is that we need to cut loss, okay, in order to manage our risk.
Right. Thanks, Hubert, for sharing your perspective. The next question is, are there any alternative asset class that we can consider to complement our when it comes to building our model portfolio?
Yeah, you can. Other than stock and bonds, you can also consider to add maybe like your properties, okay, or the foreign currency into your portfolio, okay, to construct a well-diversified portfolio.
I think there are some comments to talk about cryptocurrencies. What do you think about that?
Cryptocurrency, yeah, you can also add into your portfolio, but bear in mind that cryptocurrency is a very high risk asset classes, okay? So you need to do your own research before going into the market, okay? If today you are conservative investor, then you need to ask yourself, whether I need to go to the stock cryptocurrency or not, because it's a very high risk asset.
All right. Thanks, Hubert. So what are the benefits of incorporating international equities and debt instrument into our portfolio?
Sorry, can you please again?
What are the benefits of incorporating international equities and debt instruments into our portfolio?
Okay, so it links to the diversification across region. Okay, because if we are the stock investor, right, we not just focusing on just only one market. Okay, if we just put in all our capital into one particular region, like in Malaysia, like what we can see what happening during last year is that the Malaysia market is very bad. Okay, drop about 2%. Okay, no performance at all. So if you have 100% of the capital in the Malaysia market, okay, in this particular market, so you can see the market performance is not doing really well. Okay, so our capital will just start there. But then if we invest into international stocks like US or even also India or Japan, okay, so we can diversify our risk. Okay, maybe we can consider, or when we see the Malaysian market is not doing really well, so we can just put in 50% into this Malaysian market only, and then we can split another 50% into 3 different markets with higher certainty of growth.
All right, thanks, Hubert, for sharing your take on this. So the next question is, what are the advantages and disadvantages of passive versus active management in the equity and debt investment?
Okay, so between active management and the passive investment, the key question you need to ask yourself is that whether you got time to do your own research or not. Okay, because if you go to the active management, you need to commit on the time. Okay, you need to afterward you need to do your own homework or do your own research. Okay, maybe twice a week or 3 times in a week. Okay, you need to monitor and then actively manage your portfolio. And then when the market, uh, anything happen in the market, you need to know what to react to your portfolio management or what to do with your portfolio strategies. But then if you do not have enough time or you have a limited knowledge access to the stock market, again, what you do is that better you just assign a advisor or the fund manager, okay, to pass the money to them, okay, which are those are the investment professional that can really help you to manage your portfolio well, okay. But then when it's come to passive management, right, you need to know how to assess or evaluate their performance. Okay, not only you see the portfolio is green, then consider it is performing. Okay, you need to compare your portfolio to the benchmark. For example, like if today the benchmark, like for example, like Malaysia, if Malaysia this year can generate a 20% return, okay. So what you need to evaluate your advisor is you take your portfolio and then compare your own portfolio performance to the benchmark. Okay, if benchmark can generate 20%, but your portfolio only generate maybe 15%, then your portfolio consider underperform. Okay, but then if the benchmark is 20% and your portfolio can generate more than 20%, maybe like 25 or 30%, then it consider outperform the market. So this is the way that how you can evaluate or assess your advisor performance.
Thanks, Hubert. The next question is, how can investors evaluate the credit quality of debt instruments?
Okay, so you can just look at the credit rating. Okay, so if the credit rating of the company is high, then it means that the company financial health is very good. Okay, but usually with the high credit rating, okay, it will be result in a lower return in the interest rate in the coupon payments. But then if for those company with the low credit rating, okay, they have the very high yield, okay, those so-called high yield bonds are with the low credit rating. So for this company with the low credit rating, typically the company will compensate you with a higher coupon.
All right, thanks, Hubert. I think just now you mentioned about passing money to some professionals to manage. So the question by Eugene is that how much do they charge for fees, management, and trustee fee for portfolio management?
Okay, so there are usually there are three types of fees lah. So like I said just now, the the so-called trustee fee or the fund management fee. So all this is actually included in the fund and levy already. Okay, you don't need to fork out the money from your pocket to pay to those fees. Okay, and then another two types of fee is that usually what we can see is the upfront fee. Okay, so if you got this experience, you buy the funds from the bank, they usually will charge you an upfront fee, maybe like 3 to 5% the market rates. So for example, like 100,000 ringgit, you buy into the fund, okay, and then upfront you haven't make the return, okay, 2,000 ringgit to 20,000, no, sorry, 2,000 ringgit to 3,000 ringgit will be deducted from your investment, okay, from your capital, okay. And then, so this one is the upfront fees. And then another one is the management fee, okay, so-called rep fee, so-called rep fee. So some other advisor, like the modern way, what they do is that some advisor do give a very low upfront sale charge, okay, as low as 1 to 2%, okay. They don't mind to charge you a very low fee, but what they want to do is that they aim for a longer relationship with you, okay. They want to really manage your portfolio very well for a longer term, okay, for a longer time. So what they do is that they will charge you the rep fee or so-called management fee based on your NAV, not your capital, not your upfront capital. Like for NAV, right? Every year when your portfolio grow bigger, and then they will charge based on your portfolio value, so-called the NAV. Okay, so when your portfolio grow bigger, and then they can earn more, and then you also can earn more. Okay, so win-win situation. But then when the portfolio value goes down, okay, they will charge lower, and then you won't earn more, so they will charge lower. So also win-win situation.
All right, thanks, Hubert. Now, just like I mentioned that the banks charge upfront fee 3 to 5% when you buy bonds from them. What if you want to sell it back to them? Do they also charge this fee?
Sorry, can you repeat again?
What? Just like I mentioned that the banks charge us initial sales charge, right? 3 to 5% if you want to buy bonds from them. So what if we want to sell back the bonds to them? Do they still impose the same charge for the transaction?
Usually it's waive of the fee lah.
Okay, so they won't charge anything when you want to sell back lah. So the next question is, how can investors protect their portfolios against inflation?
Protect their portfolio against inflation. Okay, so the first thing that you need to know, how much is the inflation now? Okay, like we can see the Malaysia market, the inflation now is around 2 to 2.5%. So you want your portfolio to beat against the inflation, then at least you need to aim for a higher return than inflation. For example, like if you just put your money into FD, right, you won't beat the inflation. Okay, so if you to aim the higher return than the inflation or higher return than the FD rate, okay, so better way is to the most conservative way is that you just put your money into maybe like the dividend stock, okay, maybe 50% in dividend stock and 50% into the bonds. Maybe both of them can pay you maybe like the stable dividends or the coupon payment like into between 5 to 6%. So it's a very ideal strategy that you can use to beat against the inflation.
Thanks, Hubert. The next question is, are there any tax implications if you want to invest in equity or debt instruments?
There any implication, okay?
Tax implication.
Tax implication, okay. For equities, if you invest in stocks in Malaysia market, you don't need to pay any taxes, okay. And then for bond as well, you also don't need to pay any taxes as well. Yeah.
So what role do dividends and interest payments play in the overall return of a portfolio?
The tax role, you mean?
What roles do dividends and interest payments play in the overall return of a portfolio?
Oh, I see. Okay. So it goes back to which type of investor you are. Okay, so if you are a conservative investor, so the main focus is you will look into you'll be looking into the dividend or the fixed income, okay, provided by the debt instrument first. But then if for those aggressive investor, okay, they will not look into the dividend investing or the coupon the coupon offered by the debt instrument. So for the aggressive investor, they will just focus more on the growth of the portfolio. So what they do is they will just buy into those company with the high upside, okay, to enjoy the upside potential.
All right. Thanks, Hubert. Now we know that ESG affect the attractiveness or rating of stocks, right? So does it impact bond as well? Corporate bond.
Okay. ESG. Uh, it do not affect much actually because like if you're talking about the ESG of the stock, right? What affect the most is the funds uh, the funds from the institutional investors because some of the funds have the limitation on the ESG rating. Okay, so if those fund has the restriction on the ESG investing, so if a company do not meet the criteria, then they cannot invest into this company. And then for the bond, you wouldn't have the so much impact.
So ESG factor does not impact corporate bonds so much as compared to the share prices, right?
Yes.
All right. What are the implications of corporate earnings reports on equity and also credit rating on the bonds? If the company announce lousy results, I'm sure it will affect the stock prices, but will affect the bond prices.
Normally it won't affect the bond prices because the earnings will just affect the shareholder because the shareholder will expect the company to earn more to match to their the valuation or their expectation. But then for the bondholder, right, they just expect you can able to meet your debt application your debt application on time, then I will then for the debt then then for the debt holder, then there would sorry, your question is about the
Corporate
implication
earnings.
of the earnings. Yeah. So earning will just affect the stock prices. Okay, it will not affect the bond prices and the bond prices. Yeah, unless the company deliver a lousy result, okay, which will affect their financial health, then the bond prices may be affected.
Okay, so you're saying that financial results, if I understand correctly, may not affect bond prices that much until it severely impact their cash flow or impact their ability to pay the coupon, right?
Yes,
That means if the result was so bad that it affect their creditworthiness, that investors become concerned whether they will be able to meet their debt obligations on time. Am I right?
yes.
All right. The next question, let's take it as the last question, is that can you discuss the role of emerging markets in a diversified equity and debt portfolio?
Okay, so the emerging market is where the usually we can see the emerging market is those developing market like Malaysia, Indonesia, Vietnam, and also Myanmar as well. So those are the developing market. So as compared to the developed market, right? Because those developed market, the economic and the market structure is already established. So it's very hard for them to grow more. Okay, but then for developing market, because it's still in the developing stage. Okay, the economy is still have the very high potential to grow. Okay, so when we come into the diversification across region, okay, we not just taking we not just invest our money to develop country only because the potential for the growth is limited. Okay, so maybe we can consider to put like 50%, okay, in 50% into the developed market, okay, which where the market is already established, okay, they can deliver the earnings are expected. And then for the developing market, if we are aggressive investor, okay, maybe we can put another 50% into this country, okay, or this region, okay, the risk is quite higher than the developed market, but then the return also it could be higher than the developed market.
All right. Thanks, Hubert. I see that there's no more questions on the chat and Q&A panel right now. If you have any more, you may, do one last question, maybe, if there's any. All right. So let's do one last question. What are the key indicators should investors want to monitor for bonds?
Key indicators. Okay. The
Yeah.
first thing first, interest rate is the most important thing that you need to really look at. Okay. So when you expect the interest rate to drop, okay, it will affect the coupon payment in the future. Yeah.
All right. So with that, we would like to conclude the question and answer sessions with Hubert. So thank you so much, Hubert, for sharing with us this topic. How do we build a model portfolio with equity and debt asset classes? So thank you so much. So ladies and gentlemen, you just heard from the co-founder of BBB Wealth, who is Mr. Hubert Hyung. Thank you so much, everybody.
Thank you.